Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k. Welcome, everyone, to the Creating Wealth Simplified podcast, where each week we bring you education and information that will help you take your next step in building wealth through real estate. Thank you guys so much for joining us live today. My name is Lauren Wells, and I am joined by my co-host, Chris Seveney. Chris, long time no see on the podcast.
Yes, it's been a long time. Lauren and I have been going back and forth, recording episodes on the podcast because this past month, both of us have been having very busy schedules. Lauren on the investor relations side has been extremely busy, and myself on leading the acquisition side of things and acquiring assets. So we are back together again. Feels good.
Yeah. So this episode, we really just want to talk about a year in review, 2022 year in review. Talk about our company, our team, how that scaled, how the raise is going, talk about some case studies of some borrowers we've helped, and talk about what we've seen this year in the industry and what we think. Obviously, we cannot predict the future, but what we anticipate we'll see in 2023. So let's start off with our staff, where we were in January to where we are today. It was just us two in January. Obviously, the company's been around for a while, but this new fund and this entity was a new project and really a bigger undertaking. So we went from 2 to 10 in a year, and we now have an awesome team. I'll speak to my side and you can speak to your side a little bit. In the investor relations side of the house, we, like Chris said, this has been a very busy time of year for us. The amount of interest and people I'm speaking with has really ticked up. So we have Katie. She came on in July, but she was really onboarding investors and working with investors who had already invested. And now she's starting to work alongside me, taking some investor calls, answering questions people might have. So that's been great. We have Tony, who started with marketing and has now moved into a kind of a hybrid of marketing and investor relations, working with current investors who might have questions about their statements, distributions. We really like to have a focus on having that personal touch. We want people to know, and I get this question a lot, when people call, am I going to speak with a person, or am I going to go to an automated machine? Am I going to get an automated email, or is like an actual person going to email me? I think I get that question at least 5 times a week. So it's nice to have a good team that is committed to that experience for our investors. And then we recently brought on, and I'm excited about this, Katrina as an intern for our marketing side to help with just making sure that we're staying on top of everything.
On our end, as we'll talk about, the significant growth we had this year with the company. On the asset management side, along with running the company, I oversee a lot of the asset management with our team of Delaney and Chi, who manage our directors of the asset management. Delaney more focused on operations at this point in time, of a lot of integration between asset management and the investor relations and overall company process and procedures. And then she, along with Larissa, really managing the assets. And we have Jen, who's our transaction coordinator. And I think just a little side note I want to touch upon is the amount of work that goes into the acquisition of not only just the due diligence and putting numbers to it, but after you actually acquire the asset, getting all the paperwork in order and getting everything from the prior sellers. There's a lot, and it's pretty intense. And with having over 100 assets that we've brought into the company in the past 5 months, it's been a lot of work, and I love the team. Like you mentioned earlier, we have a great team in place, and we've got this team in place to grow with us as we continue to scale the company.
Yeah. One thing, like you said, just that undertaking of, I think, not only doing the due diligence and everything that goes with that, and then that whole escrow period where we're making sure the numbers that we put there that were accepted make sense and that we can actually work with these loans. I think something you just mentioned that I want to touch upon is you're like, oh yeah, we scaled to 100 loans in the past 5 months. I forget that the first few months of the year was a lot of working with the SEC to get qualified. We've talked about this before in past episodes, but a Regulation D offering and what we're doing in Regulation A is very different. The qualification process that you have to go through for a Regulation A is a lot more intensive. So when you look at the timeline of what's happened, the business again has been around for a while, but this new offering kind of started really last year. You had this in
last August.
Yeah, last August you had started pulling the pieces together, but we really didn't start making significant, yes, we're going to do this, forming the entity in February and really going through that qualification process starting in April. So we were qualified as of July. And since then have been raising capital, acquiring assets, working with borrowers, all the things. Chris, do you have anything to add?
No, I think let you keep going. You're doing a wonderful job.
Thank you. As far as some of the stats when it comes to the fund, as Chris mentioned, we have just over 100 assets in the fund. We have over 200 investors, about 10% of the raise hit. And Chris, I'm going to actually let you talk to this, become the asset management side, more of it. And then we've just worked with a lot of borrowers to either help them renegotiate their loan, remodify their loan, do a forbearance plan. And that's something unique to us that really at a larger scale, which we touched upon in our last webinar, is not scalable or repeatable. Chris, do you have 2 case studies that have happened since the fund launch that you want to talk about and give people who are listening right now an idea of the work we're doing?
Yeah, I'll give you one literally that just happened yesterday, which is we acquired a loan where the borrower was approximately about 10 months behind. And the borrower previously had trouble, again, getting in contact with the prior servicing company and getting a response to seeing what could be done to try and work out the loan. We acquired the loan. We're able to make what's called right party contact, contacting the right person who owns the loan, and work out an agreement where the borrower is able to put $1,500 down and pay a little extra, about $250 every month extra until they're caught up. And that allows them, because they had a short unemployment, but now they're employed and have a better job. It allows them to catch up on the loan. It avoids any type of legal or any type of foreclosure actions against the borrower, and allow the borrower also to get caught up on their loan. And during this time, we're going to waive any late fees as we go through this process and work with the borrower. And it's an example of, like you mentioned, focusing and targeting each loan, working on each loan and coming up with some common sense solutions. We've done other case studies where we've had, again, loans that we've acquired that were behind by a significant period of time. And again, as we talked on our other podcast, we always paint that 3D picture of what's going on with each loan. In this instance, a borrower had lost a significant other and was going through getting readjusted and with life after such an event. And we're able to modify that loan and rework the loan with the borrower to get them on payment plans that work. Those are 2 off the top of our head. We've got many from the last 6 years that I could sit here for hours and hours talk about, but it's that common theme where a lot of times it's going to sound like every case study typically happens of one of 3 situations of what happens in that person's life, whether it's a loss of a loved one, a loss of a job, or a medical issue. That's probably a significant number of loans where we can go in and purchase these loans because they've been neglected for such a long period of time.
Yeah. And I just realized as we started this episode, for people who are listening, you've probably listened to us before, but I made that assumption. Want to go back a little bit. And we talked about how we launched this fund, but we didn't really talk about what it was. So I just want to go back and talk about that. People might not have heard the Regulation A offering episode or might not be on our marketing email list. When we're talking about all this, and the reason we're doing this whole year in review and showing you like the growth. So when I say we went to be qualified by the SEC, we went to launch and be qualified for a Regulation A offering. And you might be wondering, if you're not familiar with us already, what that means. And essentially that means we are qualified to accept money from both accredited and non-accredited investors. So most funds, you can only accept money from accredited. We really wanted to open this up to anyone. And I try not to say this term, but I'm going to say it. Wanted to democratize alternative investing. Chris
She
is laughing
came
at me.
out with it.
I
Oh my
said it.
God.
I always try to explain it in a way that isn't using that word because I think it's like kind of overkill and it said so much. But really, that's like where my heart is. And what we are trying to do is give everyone an option to get in. We launched this fund, has a minimum of $500 investment. We are offering bonus shares. And part of our recap here is, if you are wondering, yes, we do still have bonus shares available, which start at a $25,000 investment. Again, it's open to accredited, non-accredited investors, and we can work with people who have self-directed IRAs as well.
One thing I want to add is we talk about the Regulation A plus offering. And for people who have been listening to us for years, you know this, but if you're a newer listener or just coming through our channels through kind of the Regulation A plus offering, 4 years ago, been just over 4 years, we started what was the Good Deeds Note Investing podcast originally. And as I've been investing in notes for the last 6 years, the reason why I started this Regulation A offering, and there's always the why, is we had in our prior funds, the Regulation D 506C was limited to accredited investors only. And I had worked with a lot of investors and helped them buy notes or whatever the case may be, who were interested, but didn't hit that accredited status. And they wanted to get involved. They wanted to learn a little bit about notes, but they were just left out. And one of the things when we wanted to come with this Regulation A offering was, like you mentioned, to democratize it, give everyone the ability to invest in mortgage notes, as well as work with our mission is also trying to work with those borrowers on that end. And you see so many other funds just go the Regulation D route. And there's a lot of people who are interested, like I said, to invest. And we wanted to make sure we're giving everybody that opportunity.
Yeah. Probably should have started off with all of that. But again, I forget that people come and go into the podcast world. Wanted to make sure that we covered what this fund was that we were talking about in this company that we scaled to 10 people. I think an important thing is this year we really came out of the moratoriums, lockup, all of that, and started to see those legal proceedings move forward in some states and return to normal as a world. And what have we seen since that's happened in our industry? Do you want to talk to that a little bit?
Yeah, this year is really the tale of 2 years this year. The first half and the second half of the year were extremely different. And I think the economy in general and the world in general has seen a lot happen over the last 6 months. The beginning of the year was very conservative and slow in the note investing space. We were seeing assets, which we always see plenty of assets, but it wasn't a typical year on average because of, I think there's still some of the backlog from the COVID and the moratoriums. And then middle of the year, kind of June, rates and inflation really started to take off. And I think people realized that was the pinnacle of housing. And now I think we've come over that little hump right now, and where it ends up, nobody knows. But I think we're starting to see some slide in housing. You're starting to see a slide in the markets. And we're starting to see also the uptick in inventory in that mortgage note space over the last 6 months. And as a perfect example, over the last 2 days, we have seen come through over 250 assets, $50+ million in assets for sale. 2 weeks ago, there's about $160 million in assets. Just this month, we've seen over $250 million in assets come through available for purchase. And that doesn't even include some others that we'll be seeing as well as we wrap up the end of this year. So when you look at pretty much seeing that on a consistent basis, it's over $1 billion a year. And again, as we mentioned in the past, we're just really trying to scratch the surface with growing the company to target that 75 million in a $500 billion distressed debt industry.
And when you talk about that, because, I'm speaking with people all day who are asking questions about the fund and the industry and whatnot, how does, obviously we have more inventory now. How does that affect what we do? How we're approaching our due diligence process?
Yeah, our due diligence practice is, I'd say it's pretty much the same. We go through the same process on every single asset. When we see a lot more assets, of course, we're going to be a little bit pickier because if there's 1,000 assets on the list, we're not going to go through all 1,000. We'll typically start with, we have a buy box and criteria that we will look at and fit in, whether it's state, price, unpaid balance of the loan. So we have a buy box that we will filter those things through and start and go through those assets and look at, okay, do those fit our criteria? And we'll look through those and bid accordingly.
Yeah. So you would say pricing, one, you can be picky, we can be pickier. And two, pricing has softened a bit because there's more inventory out there.
Yes, pricing has definitely softened within the space. And I think we'll continue to see it soften as we go out, because a lot of funds that were getting their money, the larger funds, a lot of them might get their money from institutional, such as insurance companies and others, which in the past, they may have been getting money at a very cheap rate, but everybody knows what has happened with the cost of money over the last 6 months. It's more than doubled. So they're starting liquidating some of their portfolios to get some additional cash.
Now, looking ahead to 2023.
Yep.
What are your predictions on you can go with the company or on I was going to say the market in regard to our asset class?
Yeah. So I'll let you talk about what you're excellent at, and I'll talk on the asset side of things and where I think that's headed, along with, I'll also talk overall markets. Again, I'm not a market analyst. I like to look at common sense a lot of times for where things will be headed. From an overall market, I think house prices, we're going to continue to see some softening in house prices. I think there's going to be limited transactions on the house front, because if people don't have to move, why would you move unless housing prices continues to go down? Because if you're locked in at a 3% interest rate, rates are going to probably float somewhere between 5 and 6% this year, which my first house was 2001. And when I bought it, which I was at 6%. So 5 to 6% is probably more normal. And the 3% is actually what is more not normal, abnormal. But along with that, because of what the Fed is doing with the interest rates, I think there's a stat that like 60% of homeowners live paycheck to paycheck. And as core inflation is still around 6%, and still expected to go throughout next year, I think people who had some savings or were saving up during COVID, a lot of that savings is starting to dwindle down. And I think we're going to see a lot more distress in the market. Again, I'm not predicting crashes or anything along those lines. The number of distressed loans has been at all-time lows over the last few years, because the economy's been so good. I think that's going to start to uptick, and we're going to start to see more of that. I think we'll see some softening in housing. And I think along with that, we're going to see more inventory for us that's coming through at reasonable prices because of that inventory uptick. Internally, I think our company is right size. We spent a lot of time looking at and analyzing the company growth and where the people we need. So we're not being reactive. We're always been proactive on the company side of things. So we have the right team for the right growth going into next year to continue to manage our assets, to work with our borrowers and to buy loans, and also look to liquidate some of the loans from our portfolio as well to regenerate some of that.
In the new year, I feel like people will be looking more outside of traditional stocks and bonds.
The Regulation A plus it's still in a very infancy stages of how it's continued to grow. And a lot of companies now are using that as a method or path for alternative investments. And for investors, I think it's something that is going to become a lot more mainstream as we continue to go down these paths, because it's that interlude between the public companies with the stocks only and other types of investments. And this alternative investment is, I think, a good vehicle to go down. And I think with the notes, with where our business, we're not as dependent on housing pricing and interest rates and the correlation between those compared to things like real estate syndications, where you're buying a multifamily building that is really correlated to interest rates, rent rates, and valuations, which include cap rates. For us being uncorrelated, and we talk about that a lot more, which that's a whole nother episode we could talk about. I think that also gives us an advantage. What else, Lauren?
I didn't have much for this episode. It was really just a recap of the year, what we've seen as this year closes out, and what we're looking and anticipating in 2023. Do you have any final thoughts?
No, I think for people, again, if they have questions, and I'll let you give your spiel, but I do want to just first, before I throw that out there, I do want to thank everyone for listening to the podcast, people who have invested with us, people who have been supportive of us over these years. I truly want to say thank you. Without all of you, we wouldn't be able to do this or be where we are today. So I just want to give a shout out to the investors, my vendors, the team, Lauren and the IR staff, and Delaney, Chi, Larissa, Jen, Katie, Tony, Katrina. And I said you, Lauren. Did I miss somebody?
No, Julie.
Oh, Julie as well. Yes. Which I should remember Julie. I just paid all the bills.
Yeah, I was going to say the same thing. Thank you to us. I know Katie and Tony would feel the same, and I'm sure Chris feels the same. We love our investors. We have some awesome people. We're thankful for them. And also the listeners of this podcast. And not only that, it's really awesome to see when someone will organically, like unprompted, post something about Seveney investments and receiving their first dividend check. Someone who may not have invested $250,000, $300,000, $400,000, someone might have started with $500, the minimum. And just to notice that they're like, hey, I got my first dividend check. It's pretty cool to see that. We've seen randomly been tagged in a few comments on LinkedIn and on Facebook. So it's cool to see that as well, not only helping the borrowers, but also seeing the investors get that.
And I think the other thing that for me is at a call with somebody last week where they mentioned, they're like, I feel like I know you because they've been listening to the podcast for so many years. And that makes me feel good that we add value to people when we try and educate people on note investing. And the other is we just found out recently that we won an award through another website, noteinvestor.com, awarded us the best social media networking group, which we have a Facebook group with over 2,000 people in it. And being recognized by people outside of our group and having that group and that culture is, to me, it makes me feel a lot better, warmer inside, knowing that we are helping not only investors, borrowers, but also people, other investors who aren't even investing in a fund, just educate them on the space.
Yeah. I don't know, maybe this sounds cheesy, but I really like the fact that we're doing things differently. Like the mission is to do things differently.
Yeah, the Regulation A offering, which is very rare for a note fund, the way we structured the corporation to provide some potential tax advantages. We're not CPAs or accountants. Check with your CPA and accountant. Always got to give that. But I think that also we are trying to really do things differently. And I think we are doing things differently. And when we were at conferences this year, people were, ooh, look at what they're doing. And it's not rocket science, what we're doing, and we're not doing anything I say is like risky of what we're doing. It's we structure things in a way that I think benefits all the parties involved. And that's all the way down to the simple fact that if you look at our offering, we don't have management fees, acquisition fees, disposition fees, and all these other fees that you see in a lot of other funds, because a lot of those are profit centers. I've worked for companies and stuff that have funds. I know what is a part of them. I've read a lot of SEC offerings. I understand that. And we really just want to do things differently that I think is the benefits for everybody.
You like that tagline? You said it like 4 times. I like it. Yeah. No, again, thanks everyone for joining us today. Thank you for listening to the podcast. Like we mentioned before, if there's anything specific you want to hear, we have some awesome interviews lined up for 2023. But if there's anything specific or you're hoping to hear about on the podcast, like we said, this is about educating you and giving you information to really start investing in yourself and your future. So please feel free to email us. You can email me, Lauren, at seveneyinvestments.com. If you have any ideas, you can email Tony at seveneyinvestments.com. And that's Tony with an I. The show is for you guys. So please, feedback is appreciated and always welcome.
And one last thing, because we didn't get to answer all the questions in the chat, we apologize. We will reach out independently to all of you and answer those questions for you.
Thank you guys so much again for joining us today on this episode of the CWS podcast. If you enjoyed the show, share it with a friend, subscribe, or leave us a review. Until next time.
Thank you. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.